it's always a great time to buy a great deal.
Oh,
so
absolutely.
No matter what's going on in the economy, no matter what's going on in the stock market, if you have the capacity and you find a great deal, this is how you tell, right? This is how you tell. It's like, does this deal pencil? My old saying on residential real estate: if there's not room in the deal for a property manager, you're not buying an investment, you're buying a job. But Brandon, the home goes up in value, the price increases. And the reality is it can for a time, but it can only decouple so much from fundamental reality.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks Podcast. I'm your host, Brandon Ducharme. Joined today in the studio with me is my colleague here in St. George, Utah, Carissa Bertrand. And today we're going to talk to you about, is real estate a good investment? How do we know?
Yeah.
How do we analyze that? Super common question we get from people. And one of the things that we get a lot in our practice is this question, or not really a question, but more of a statement of like, hey, I've got a bunch of money, and so I need to buy real estate now. And it's like a default investment people think they need to make. And I don't blame them. The recency bias, like behavioral finance is real. Yeah. Recency bias is like,
especially from 2020 to 2022, even that most recent. It's
been super hot, but the reality is like, real estate since, depending on the market you're in, 2010 to 2012, it's really just gone up. It's been super low volatility. Like rents have just steadily increased. Inflation was low, so all your expenses were, low. Water heaters weren't costing more. There was good demand, so turnover was low. And turnovers were quick, right? There weren't supply issues. So if you had to turn over a unit and you had to do a lot of rehab on it, it was easy to find your contractors. It was easy to get supplies or material, right? So real estate was a really great asset class for those years. Like it had great years of returns. Yeah. And that builds recency bias in people, right? And the problem with financial markets is they're not about what's happened the last 5, 10, or 20 years. It's all about what do we think is going to happen the next 5, 10, or 20 years. Yeah. Right? And that's what it has, what has been really doesn't matter. It matters what is today and what we think is going to happen going forward, right? And so what I did is pulled out my old real estate analysis model that I built in my undergrad down there at Utah Tech.
Good times.
Dixie State back then. Anyways, it's a really interesting model I put together when I took real estate finance. And I've used it. I actually still use it when I analyze deals with clients. Yeah. I think it's probably a bit more nuance than a lot of people care for it to be, but that's the reality of it, right? It's the numbers. So what we're going to go through the numbers and try to understand how we look at a real estate deal, right?
Cool. I think this is going to be super helpful for people to get like a better understanding of thinking of real estate as an investment rather than an appreciating asset as it has been in the past.
Yeah. Hey, if anyone's like listening and they want my model, right? Like, reach out. I'm happy to have a quick conversation with you and maybe show you how to use it. And I might be willing to share it. Yeah. I got to maybe run that by compliance, truthfully, but I'm
sure we can make it work.
Yeah. At a minimum, I can give you the basic principles on how to build it yourself.
Yeah.
This model is really nothing more than really going through like the textbook of like real estate finance.
Like what are the numbers that I should be looking at?
Yeah. And I just built it.
What should I consider?
Yeah, and I just built it into an Excel. It operates in Microsoft Excel, and you can just dynamically change the inputs, and it changes the analysis right automatically for you. So this is the deal we're going to look at today, and I kind of picked these numbers This is generally what I'm sort of seeing in the St. George market for like single family home investments. Right?
Okay.
I think they're pretty generous numbers, realistic. Now, before we get into this, I'm going to pause for a second and say, like, Carissa, it's always a great time to buy a great deal.
Oh,
so
absolutely.
No matter what's going on in the economy, no matter what's going on, in the stock market, whatever, if you have the capacity and you find a great deal, this is how you tell, right? This is how you tell. It's like, does this deal pencil? This is how you go through the numbers, right? So
yeah, and I think that's like the key to what we're going to be talking about today, and like this whole episode is how do you actually determine if it's a good deal or if it's just noise, right?
Yeah, well, or noise, but I mean, in reality, I think what people are going to see is like the price you pay really matters, and it's the same on a fundamental level in stocks. It's true, right? Over a long period of time, the price that you pay when you buy the asset really does matter. But unlike the stock market, housing isn't liquid. And so you don't get that volatility along the way that gives you opportunity to buy and sell or manage or, sell a little bit because you need a little bit of cash because, it's a house. It's kind of all or nothing, right? So it doesn't have that same flexibility. So that's not good, bad, right, or wrong. It's just different.
Correct.
Right.
Yeah.
But because real estate now becomes such a long-term investment, you got to look at the price you pay really matters with the long-term. What's the long-term returns really look like? Yeah. Okay, so here's the deal we're analyzing. An acquisition price of $425,000.
Okay.
In our county, that probably is going to get you maybe a 3-2 townhome.
Yeah.
So you're talking a normal single family rental kind of idea. 80% down, or sorry, 20% down, so 80% loan. Yeah, 80%.
Whoa,
down.
that's not normal.
Yeah. So just so you're doing a 20% down.
Okay.
Right, investment loan. So no, goofy extra high interest rates or weird balloon payments on the road. So financing terms can change these things, but that's kind of the standard. 30-year loan, 7.5% interest rate, which I think is in the current environment. You might be able to get a half a point better, but as an investment loan, you're probably paying about a 7.5, I would think. Closing costs at 2.5% of the purchase price, origination fee of $1,000, title policy, title expense $2,125. I run that at calculation about half percent there. It really is what that is. Home inspection and appraisal costs $1,250. All right, so you got to pay for an appraisal when you buy a place, and then you got to pay for a home inspection. Home inspections were $500 to $700. Back a couple of years ago. I would think they're probably maybe on the closer end of $750, but between appraisal and title, anyways, we're getting into the nitty gritties. But a good model gets into the nitty gritties. You got to make the assumptions, right? You're talking about deploying capital. You got to understand it.
Absolutely.
So your cash to close on this property, you got to bring $97,875 to the table, right? Your monthly payment, not including taxes or insurance, be $2,377.33 for an annual total debt service of $28,527.95. Okay. First problem we're going to run to is I think that property only rents for $2,250. And I think that's like, if it's a newer property, you're probably $2,250. If it's an older property, it's not in great condition, or it's a connected townhome, or like it doesn't have a garage, some of these other features, right? Like you might not even get that.
Yeah.
But certainly we've been seeing in the market some downward pressure on rents. So at $22,250, you're immediately underwater on cash flow.
Yeah.
Now that gives you $27,000 a year in what's called PGI, or potential gross income. And that means that if your unit is PGIs, if your unit was rented 365 days a year and the tenants paid 100% perfectly on time, that's how much you get paid.
And
right?
they're not creating any issues for you. Or
that's just top line. That's cash that comes to you before you deal with anything else. And remember, that's perfect. Okay. So then what you do is you apply what's called a PGI growth rate, or potential gross income.
Okay.
So you're going to grow those rents year over year. So this is accounting for, hey, every year that $22,250, like it goes up, right?
Right.
And people generally get excited about that. Now, I will stop and say, I think that's really generous, actually. I don't think you're going to see a 3% growth rate
year over year.
Year over year.
I mean, a lot
looking where we're currently at, but I think that's going to become, my reason for that will become a little bit more apparent here.
Okay.
As we go. Okay. So that's how you get to PGI. What you have to do now is go through your operating costs, right? So your first one is what's called vacancy and collection loss. And this is simply like a plug that you have to put in. That's going to subtract on paper from your monthly cash flow. But what it's doing is it's accounting for that month that, somebody moves out of the property, it's vacant for 2 weeks between tenants, right?
Yeah.
Or sometimes maybe somebody's there for 2 years or 3 years, and then it's empty for 2 months between tenants, right?
Mm-hmm.
So, how much of your money is going to be not collected, right, of that PGI because of just that gap, or somebody moves out and stiffs you with, 2 weeks of rent or last month or whatever,
I think with
right?
that 1%, that's pretty,
it's incredibly conservative. So in reality, like textbook or good operators are probably going to put in something more along the lines of 3 to 4% for vacancy collection.
That's what I was thinking.
Okay. Now I put in a management fee as well.
Mm-hmm.
My old saying on residential real estate, any kind of real estate, if there's not room in the deal for a property manager, you're not buying an investment, you're buying a job, right? So hire the property manager. If the numbers don't work with a property manager, the deal doesn't work, right? Okay. The management fee I use is an 8% fee. So 8% of your rents go to the property manager.
Okay.
Now, that's a little bit on the low side. Remember, I would say in the industry, it's probably a little bit more customary to see 10%. Sometimes you'll see like it's pretty common. Maybe you might see 9%, but then there's a lot of hidden fees. So it's usually when you get to 8% and there's not a lot of hidden fees, it's actually because you have like 15 or 20 doors with the same property manager. So you're getting a volume discount. But I'm trying to make this be as advantageous as possible, right? Like, and partially it's to illustrate where are we really at in this real estate market, But okay, capex, 1.37%, and so capex is capital expenditure. And so this is like your budget or your estimation for what it's going to cost to replace that water heater over time, right?
Okay.
Now, you don't replace a water heater every single year.
Right.
But what you have to do is you have to budget for it, right? You have to budget for it in the year, every single
you never know
month
what
out
year
of every
that's
single
going to
year.
happen.
Yeah, right. And so at some point it drags on your P&L and it hits all at once. But if you've kind of budgeted for it to be built into your return assumptions and all this kind of stuff, then it goes okay. So 1.37%. Now, listen, that's on a $425,000 house. It's just over $4,000 a year. It's $5,000 a year.
It's like 2 to 3 months worth of rent in this scenario here.
Yeah, it's
out of the year.
Like, and that sounds high. I think a lot of people that own homes would probably see how like maybe that's not so high. And then in reality, in like single family homes, like things go wrong, right? Like you have to fix things.
There's always
and remember,
something.
If you think the maintenance is expensive on a home you own, remember that no one takes better care of your home than you, right?
Yeah.
So renters are notoriously hard on properties. Now, if you want to adjust it down. 1.37 is, my number on this last deal I did. But whatever, adjust it to whatever you want. My point is you have to have something in there for a capital expenditure budget. Now, good operators, they tend to know what that spreads out to be across all of their properties on average. And so they tend to have a plug per door. That's like a flat dollar amount, right? So you might look at it and say, if you own a number of properties, maybe you're budgeting, hey, it's going to be $250 per month per door. Is what they expect to spend on, contractors and repairs and stuff, right?
Yeah. I do think that is one area that a lot of people forget to add into their calculations originally. Because again, it's that you take better care of the home than renters are going to take care of it.
Yeah.
And so like replacing carpets or flooring,
painting it when they move out.
Yeah. Like just all the little things. It's not always like the big maintenance, like the water heater, or the furnace or things like that, air conditioning. It's the little things that add up every time you have to replace or switch out tenants and things like that too.
Yeah. It's like, and the cost might be really low for a lot of years. And then all of a sudden in year 8, you got to do all new floors in the whole house for $20,000.
And then a new washer and dryer, a new, like different appliances, right? And those add up quickly. So.
Yeah. Just fine. It's part of the deal, right? You just build the numbers in.
Yeah.
Okay. Property taxes. Now in Washington County, it's about 0.5% a year. And you get then as long as whoever you rent it to, it's their primary residence, you can still qualify for the primary residence discount in the county here. So you get a 40
for the person that you're renting it to.
Yeah. So if you own a home in our county, this is how it works.
Okay.
In Washington County, Utah, if you own a rental property and your tenant, it is their full-time residence, then the property can still qualify for the discount on property taxes as a primary residence.
Okay.
The county sort of idea on that is the person living there is here spending money in the county and participating in economic activity of the county. So that's why they get the discount, because they're paying taxes in other ways, other places.
Gotcha.
Right. So you get a 45% discount on that roughly 0.5%. So your adjusted tax rate's only like 28 basis points a year, or 0.28%. Once you got to factor that in. Now you also have to factor in HOA dues. In my analysis, I'm kind of a fan of owning properties that don't have HOAs. So I put no HOA dues, right? Like, but that's where you would put it.
Harder to find.
It is getting extremely hard to find. But that's where you would put it in, right? Don't forget about HOA dues. And then you have insurance premiums. Now, insurance premiums on rental property are a bit cheaper. Oftentimes they're called landlord policies.
Yeah,
a bit cheaper than regular homeowners insurance. So in my case, I use an insurance premium of $600, right? And then a growth rate at 2.5%.
And just to clarify for everybody, that's $600 a month.
600. It would actually be 600 a year.
Okay.
Yeah. On like a larger commercial building, it could be more, something like that. But on a residential building, it's gonna be more like actually like 600.
Okay.
But what you have to do is you have to remember like all these costs that aren't a percentage of like the property value. So like taxes, it's a percentage of the property value. So as you grow a property value or decrease a property value, the tax bill will increase and decrease automatically.
Right.
Insurance, you have to apply some kind of growth rate to it, right? Because it's not tied to the property value explicitly.
Yeah.
Right?
But with inflation, it's going to continue to go up over time.
Yeah. So like I put in like 2.5%.
Okay.
And the reality is like, if you're planning on growing rents at 3%, your insurance is probably growing more than that. But if you go inflation plus a little, again, I'm trying
There's
to
always a little bit of variability within these numbers.
I'm trying to be
regardless
generous
of how specific you try to get.
Yeah.
Right?
And I'm just trying to be, so in some of these areas, I'm trying to be generous to, illustrate the point. Okay. Now what you have to do is you have to apply what's called a discount rate.
Okay.
So a discount rate is like, hey, so you've got $97,000 you're going to bring to the table. You've got $97,000. You're ready to invest in something. Well, the first thing you have to say is like, well, if I just put it in something that has no risk over the next 10 years, what does that pay me?
Yeah.
And so the common benchmark is the 10-year U.S. Treasury note, which right now pays about 4.25%.
Okay.
Okay. And so the theory kind of goes in finance here with using a discount rate or a risk-free rate is I'm going around here, $100,000. I can get $4,250 every single year for just owning something that the government owes me the money on,
risk,
and the government guarantees me the payments on it. So I have no risk of getting those payments, and then I have no risk of getting my $100,000 back at the end of 10 years. Right. And so if I'm going to make an investment somewhere else, I got to get some kind of premium too,
right? Because you're taking some additional risks.
And so that's where you put in a market risk premium. Now in this model, I put in a market risk premium of only 1.75%.
Pretty low.
That's a really tight market risk premium.
Yeah.
That's you just saying, hey, I'm willing to take on risk if I get an extra 1.75%.
Which I would say most people are probably not willing to take the risk for that low premium when they fully understand. So
here's the reality. The 1.75% right now, and the reason why I use that, again, being really generous, is that's what the current spread is on mortgage bonds. Okay. So literally like you really now have a new hurdle rate that you can say like, do I want to invest in real estate or I want to buy the bonds?
Right.
And the new mortgage bonds pay, about 6% right now, and they have pretty low volatility actually, but they're also like, because they're because of the GSEs, right? Fannie and Freddie, the credit quality of the bond is still guaranteed by the government. So there's no credit risk in it. Anyways, but my point being, like, it's not hard to get 1.75 still. So like, you really want to have something that's better than that.
Right.
Maybe.
Yeah.
If you're going to go deploy capital, especially for an extended amount of time, right? Like 10 years.
Yeah. I would say that 1.75 you have here is probably like the minimum of what I would want to look for, at least for me.
If I was going to go deploy something into a long-term asset.
Yeah.
Yeah. But that, especially if it doesn't have liquidity. Remember, like,
yeah.
if you have liquidity in between, it's a totally different ballgame, right?
Absolutely.
Because when you look at the 10-year treasury, there's going to be plenty of volatility in between. You're just saying, do I get my money back at the end of 10 years, right?
Mm-hmm.
So it's a 10-year commitment. So it works in the direct real estate comparison because it's like a 10-year commitment, right?
Right.
Remember, it's difficult to transact real estate, right? You have to get it ready. You have to put it on the market.
Mm-hmm.
You have to go through the transaction process. There's a lot of cost
associated
involved in transacting, right? So once you have all those numbers, you can look at your potential gross income. You kind of subtract out all your costs there, and it gives you your what's called your net operating income.
Mm-hmm.
From there, you can discount all those cash flows in the future, right? So you can grow all those rates out. You can then pull it back to the future or to the present and say, what's my net present value of this deal?
Yeah.
And essentially, like, net present value, it tells you how much it tells you how much you're getting for your money, right?
Right.
So,
in today's dollars.
Yeah. So you want something that has a positive net present value. It's a great deal.
Mm-hmm.
Generally, if you put in a market risk premium of 6% and you get 0 on the net present value, it basically means you're projected to make a 6% return. Okay.
Okay.
If you have a positive value, it might be indicative that you're getting something like 6.25%, 7, 8, 9%, right? So bigger the net present value. The bigger the net present value relative to the discount rate is, you're going to have a higher return than the discount rate.
Okay.
Okay. In this case, your net present value over a 10-year holding period is $120,000 loss. Negative $120,000 in this deal. So it's like,
and
what does that mean?
Holding
it's like,
it for the 30 years.
No, it's 10-year holding period, right? So I'm going to buy this
period,
property. I must, have it for 10 years. I'm going to hold it.
Okay.
And so sometimes people say, like, well, Brandon, you never sell real estate, you never do anything. It's true. You break even on this deal, break even. That's not adjusting for inflation even. That's not even talking real return break even, nominal break even, 31 years. My friends. Not
a deal that I want to get into.
So here's the deal. This deal would trade at what's called a cap rate.
Mm-hmm.
So your cap rate at purchase is 3.73%. That simply means, like, if you took out the leverage component and just bought the home for $425,
mm-hmm.
no cost of leverage, what would you get on your money? Like 3.73%. So all else being equal, like,
you're getting
a lot of people, you
rate.
make more money right now probably putting your money in CDs somewhere.
Yeah, or high yield savings.
than in real estate sometimes.
Okay.
No, that's not always. And
Right.
It's a great time to buy a great deal.
Yeah.
Okay. But this is how you start to understand the numbers, because it's not all sunshine and rainbows, right? Real estate doesn't just always go up. Now, I already know what people are going to be saying, because they say it to me all the time. But Brandon, the home goes up in value, the price increases. And the reality is it can for a time.
Mm-hmm.
Okay. But it can only decouple so much from fundamental reality. And the reality is it's already stretched.
Yeah.
So if rents are ticking down, what makes you think the price of the home is going to go up much more? Right.
Mm-hmm.
In this example, if I was looking at it and I was saying, hey, so, like, say you own this home today, and now I was looking to buy it as somebody that was going to live there.
Okay.
Right. I've got an amortization table for the mortgage on page 3 here.
$340,000.
Yeah. Now, not perfect, because it's got the higher interest rate for being a investment loan.
Well, and this also has just the P&I. It doesn't have the insurance and taxes too, so that can change a little bit.
But if I said, okay, my mortgage payment, assuming I got the same loan that we talked about in the beginning, right?
Right.
$2,377 is my mortgage payment for principal and interest. I still have to pay the insurance and taxes. So my payment really probably comes out to something like $2,700. And if I can rent it for $22,250 or $2,250, then I can keep my remember this accounts for a $97,000 down payment.
Yeah. Hey,
I can keep my $97,000 down payment, which, hey, at 4.25% or 5%, right? At 5%, it's $500 a month or $5,000 a year, just over $400 a month. So now you're like, well, I could do $2,250, but I also get $400 a month for my own investments, right? Of keeping my down payment in my own pocket. So it really now takes your cost down to $1,850. Well, do you want to buy it and own it for $2,600 a month, or do you want to just rent it for $1,850?
Yeah.
And if the answer is like, well, I'll just rent it. Well, like somebody can keep bidding the price up, but at a certain point, if investors can't get more out of the rents, right? Like it just is worse it's a worse and worse time to buy the real estate. You want to be able to buy in a position where you can increase the rents, right? You want to buy just like you want to buy on a very fundamental level, right? Like finance 101. You want to buy companies that have the ability to increase the dividends.
Right.
Right.
Yeah.
In real estate, rents are the dividends, you know? And so you don't want to buy a company that has a very high valuation and they're saying, and by the way, we're facing some headwinds and we're going to be cutting the dividend.
Yeah.
That's not just finance 101. That wouldn't generally be a good idea. Now, I will add that there's a caveat here, which is if you have edge, right? That is to say, like if you have a specialty or you have information, like you find a dislocation in the market, right? So in stock pickers and analysts try to do this, right? So they go to look and they say, hey, everyone's dumping this stock because the valuation's really high and they're thinking they're going to be cutting the dividends. And so no one wants to own this thing now. And we think they're going to be bringing this new product to market or getting access to a new demographic, or they're going to land a new contract or whatever. And it's going to turn things around really quick. So we'll buy into this struggling or difficult time. So if you found this deal that we're talking about and you found out that they're doing some major rezoning right by it or something like that, right? Like there's all of a sudden this significant change coming that you know about that other people don't know about.
It's going to significantly improve the property value.
Yeah, then you've got edge and maybe it's worth buying because you're going like, hey, this is going to totally change in 6 months, right? Like when that information comes through and everyone knows about it. In real estate, it's okay to buy based on that. If the person selling doesn't know,
as long as you understand the risk that things could fall through, right?
Things could absolutely, right? But like that's okay. And sometimes that's where you make really good money in real estate, particularly like in development, right? If you can buy a piece of land and you buy it as, you know, farmland and it's cheap, or grazing land, and then you know that you can get it rezoned to commercial and build something entirely different, like change the fundamental purpose of it, then boom, right? Like there's stories of people going up and buying homes where they know or have a speculation that there's a certain maybe like big company that's going to come in and build a massive manufacturing facility or something. So there's going to be a demand, this massive demand for housing in the area because all these people are moving there for this new employer that's cropping up, right? Like that stuff happens. And again, always a great time to buy a great deal.
Yeah.
But ask yourself, like, do I have that information? And if not, then you're just like you're operating on the same information everyone else has. And you got to operate on this kind of analysis and just saying like, look, what are the raw numbers?
Understanding those
and
numbers,
the raw numbers here are like, you're talking, you know, so if I said like, hey, I'm going to adjust the sales price when I go to close based upon what I think interest rates are going to be at. Well, if that discount rate, somebody buys it at a 5.5 cap, you bought it at a 3.5 or 3.43 or sorry, 3.75.
Yeah.
If you sell it at a 5.5, 10 years down the road, you know, like what that ends up being is only $382,000.
Where you purchased the loan for $340,000.
And you got to pay, remember, you got to pay broker's costs on the sale. And we also accounted for 3% growth rate on rents every single year, you know?
Yeah.
Compounding. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. So increasing the rents still wasn't enough to help you out, right? To push the value of your property higher. And so like a lot of people are going to say now, and they're going to say like, this guy's nuts. Real estate doesn't go down. Listen.
We've been seeing that.
We've been seeing it, but even if you say it doesn't go down that much, okay, but there's nothing that says it has to go up either, right?
Right.
And I don't have a crystal ball on exactly what's going to happen in the markets, but what I do know is if I look at interest rates and you look at long-term cycles, they run in 40-year cycles. So they came down for 40 years, right? Interestingly, halfway through that down cycle, they fundamentally changed real estate by turning it into a financial asset in the United States instead of it just being a shelter, right? So that was in the late 90s and early 2000s. Okay. Look at the problem that caused in 08. And then what they did, instead of letting that self-correct out and say, okay, that was a bad policy.
Yeah.
They went ahead and ran QE for all those years. They have the government sponsored entities, right? They federalized or nationalized the mortgage industry, right? They backed all these loans, taking the credit risk out of the bonds, artificially suppressing the interest rates lower. They kept these interest rates low, low, low. And that caused real estate to rise. And that really bottomed out in 2022. 42 years, so it's a little off cycle. Depending on what bonds and interest rates you look at, you would really say 2021.
Yeah.
Okay, so pretty on time. And what we've seen since is all these people that have the recency bias around real estate. And I got so much flack for this in 2022 and 2023 when they said interest rates will be back on mortgages to 3% by the end of 2022. And I said, it is not going to be that way this time. It cannot happen. And so then the last 2 years, what we've seen is the Fed's going to cut rates. The Fed's going to cut rates. They're going to be lowering interest rates. They're going to be lowering interest rates. There's going to be all this buying pressure. And what we've seen is ever since they started lowering the interest rates at the Fed, the rates on the long end, the 10-year treasury, which drives the mortgage rate, by the way, has increased and increased and increased. And every time we get into a route of any kind of issues, right? We're filming this April 1st of 2026. In the midst of this Iran conflict. Trump's got his big speech tonight. Who knows what will happen? But what I do know is when the market started initially selling off on the Iran conflict, bonds sold off too, which means interest rates went higher. And so like there's a reason why, and the reason why is interest rates are too low, in my opinion. Like bond investors are looking at a lot of underlying issues in markets and economies and money supply issues and saying there's too much debt, there's too much printing that's going to happen to pay all these debts. And I don't want to own your bonds.
Yeah.
Right. I don't want to get paid back 6% or, 4.25% over 10 years when you've got the ability to just print the money to pay me back. And that's clearly what you're doing. Right.
Yeah.
They are demanding more, and that is driving interest rates higher for housing. So I think we're going to continue to see that. I made a pretty good call, not that I'm always perfect, but I made a call towards the end of last year, and I was telling people, if you're going to refinance your mortgage or you're going to buy a home because you need to buy a home, it's a pretty good time to do that. And I was pretty consistent on that throughout Q1 of 26, especially early on. And that was just looking at, the 10 years cheap relative to fair value. And the spread on mortgages is incredibly tight.
Yeah.
If they thought interest rates were going lower, mortgage spread would actually be wider because they'd be saying, well, if you're likely to refinance this, then I want more premium.
You a higher premium for that.
Yeah, for that optionality to refinance.
Yeah.
Okay, so the spread would actually widen, and it's historically tight. And then as soon as we saw any kind of disruption, boom, rates higher. And I think that's going to sort of be how it goes for, so 1980 to 2021, 2021, you're probably, 4 decades, run it out. I think, now that's not to say that they just go up every week, month, quarter, year, right? There's always counter trend moves in anything. And so you're going to get, in my opinion, like there will be years or maybe even a couple year segments where the rates are a little lower. You know what I mean? Things are going good. Rates drift back down. We've already seen that in some of the moves, right? We initially saw mortgage rates as high as like over 8%.
Yeah.
And then they drifted all the way back down to 5.5.
Now they're back up to 6.
Now they're back
7,
up to, they're in the 7s, depending on what program you're looking at. And so like, you're going to get these fluctuations. And I'm not saying interest rates are going to have to go to like 20 or something crazy. I'm just saying like they're going to be sustained
we're
higher.
Not looking at that 2 to 3% rate again that we did see,
The bias is to the upside on rates.
Right.
And if the bias to the upside is if the bias is to the upside on rates and affordability is already stretched, it limits the capacity for people to bring more money to the system, create more credit to give you exit liquidity at a higher price on your property.
Yep.
That's the gist of it, right?
Yep.
Now, that could all change. I don't know. Like, I don't have a crystal ball. So you got to navigate the world as it changes. But
as it stands today,
there's not a lot of room. You can't just run out and say, hey, real estate's been growing at 6% a year in St. George, so it's just going to do that forever.
Yeah.
That's not how, like when you start a small business, at some point when Jeff Bezos started Amazon, he was growing sales probably by like 10,000% a year. There's periods where they probably grew sales by 10,000% a month, and they might have done it for a sustained period of time. But Amazon cannot grow their sales by 10,000% a year anymore. It's just not economically possible.
Yeah.
Right. And so, God, they couldn't grow it by 1,000%. They probably couldn't grow by 100%. I don't know. I don't look at the fundamentals of Amazon. But what you have to understand is, right, at one point, Amazon was a small, nimble company that was getting out there. And so as they acquired new customers, the growth rate was incredible. Right. And when you become one of the largest companies in the world, you can't build on the margins that way, right?
Yeah.
You can't
it gets
double
harder
business.
And harder to duplicate
it's
and
way
double.
harder to go. Right. It's hard to go from $1 million of revenue to $2 million of revenue, but it's not tough, right?
Right.
It's but going from, you start getting the big numbers, right? Like if you're a $10 million company, it's still not impossible, but and sometimes there's efficiencies you pick up. And so, hey, going to a $20 million company is not crazy, but you get to something that's publicly traded, $100 million company. Okay. You can go to a $100 million company to $1 billion company in that small cap space. And that's why a lot of people go look and try to invest in those small cap spaces, because you can get those explosive growths.
Right.
Now, very tough to identify the company that's going to actually do it. But when they do it, it's definitely doable.
Yeah.
But to go from $1 billion to $100 billion, tough.
That's a whole different beast.
Right?
Yeah.
Whole different beast. But like, okay, $1 billion to $10 billion, $10 billion to $100 billion.
Yeah.
$100 billion to, literally Amazon's like $1 trillion company, right? You're talking like those mega cap companies, $1 trillion company. Well, it is very tough to grow from $1 trillion to $2 trillion.
Yeah.
Let alone $100 trillion,
Yeah.
And so like real estate has been driven and stretched, right? And the valuations are high. I'm not saying it can't go higher. Markets do irrational things. But
the time frame is probably going to be extended more than it has been in the past for those.
But you have to really, and this is my point. I'm not saying don't invest in real estate. There's some unique cases. What I'm saying is, don't put together 100,000 and just say, time to go hire my local real estate agent and I need to buy myself a rental property because that's what rich people do or something. That is what is going to get you or people into trouble, right? We haven't dug into the just headaches that this can cause to you on your tax return.
Oh my goodness.
Which you are very familiar with.
I'm just going to say the word depreciation and recapture.
Oh yeah. But like it's a big thing to start buying real estate, right? Now, I want to talk about like one of the interesting bull cases for real estate, right?
Okay.
If you're thinking about investing in real estate. I think there's an interesting, unique tail hedge in real estate. So I think real estate is particularly expensive here from a fundamental perspective, right? However, there's in markets, if you think bonds are going to go down, you want to short bonds, right? And that's just like if you think interest rates are going to go up, if you think interest rates are going to go up, you want to short bonds, right?
And that inverse relationship.
Yeah, right. Yields up, price of bonds down, right?
Yep.
Yields down, which is to say interest rates, the price of the bond is up. So if you think rates are going up, you want to short bonds. Most retail investors, A, don't know how to pull that off. B, it's tough to be like, you know what? I think rates are going to go up over the next 10 years. I'm going to be short bonds for 10 years. Expensive, tough to do, tough to pull off. Not impossible, but it would become a pretty sophisticated trade. However, as us normies and, retail investors, we do have the capacity to be short bonds in a very, very meaningful way. And it's simply to have a mortgage, right? And here's what I mean by that. If I'm short bonds in a portfolio, I have pre-sold the bonds and I owe them to somebody. So I owe now all the interest that those bonds are producing every month. I have to come up with that cash flow, and I have to be able to buy the bond back at some point.
Yeah.
And so if you have a mortgage, you're kind of in the same position, right? You've borrowed the money from somebody. You've been prepaid on that money, and the cost of it is your interest payment every month, right?
Yeah.
On the loan, and you owe it, So, boom, you're short bonds, right? You own a mortgage. Now, what you do with the mortgage is buy a piece of real estate. Well, not a great cash flowing asset right now, in my opinion, and probably doesn't have a lot of headwind for, the steady, stable growth like we've seen, right? To just continue to grow and make a nice leverage return. However, and this is where I say it's a tail, right? So if you think about the distribution probabilities of a bell curve, right? You're talking about way out in the unlikely ends. However, it's the unlikely ends where what they call like the black swan events happen, right?
Yeah.
It's the tail events that drive sometimes the big magnitude of the life-changing things, right? And so if you look at the government's ability to print money, right? And so anyone that's listened and been following along, and you go back and look at our series on like the debasement. Allocations. I talk about this a little bit. Like why owning real estate, matters, like some high quality real estate. Because you can't print more real estate, right? I mean, like that's the gist of it. You can't print more. Now, municipalities can change laws and adjust zoning, and you could deregulate builders and try to bring some more online. But at the end of the day, right? Like if you own a piece of land isn't fungible, right? A house isn't fungible. You can't, it's different inherently. It's like real estate school, like day one is like no piece of real estate is the exact same, even if it's the same floor plan as the house next door.
Yeah.
It's a different piece of property, right?
Right.
So you can't print more of it. And there will always generally be a need for housing. So like where does this tail hedge come in? If they print an astronomical load of money and suppress interest rates super low or something to that effect, right? And there is sustained really high inflation. So if inflation's a little bit high, like where I think my base case is at over the next, let's call it like 10 years, this wouldn't pay off.
Okay.
But if inflation was like, the Weimar Republic, after World War I, then like that's where this pays off, right?
Okay.
And
significant inflation.
I'm talking hyperinflation.
Yeah.
Right. I'm talking just economic.
Double digits.
Just catastrophe, right? Like this is crazy. Like we're out on the spectrum, but if you're talking about adding a tail hedge, right?
Yeah.
Like you can't print another house. And the reality is like if you took a $300,000, in this scenario, a $340,000 mortgage to buy a $425,000 house, right? Well, if the guy working at McDonald's makes $500,000 a year, like it's going to be, the price of that home will go up.
Absolutely.
Now, on a real basis, you might still lose, right? But because you did it with so much leverage, right? Like you didn't actually put 425,000 into the home.
Yeah.
You put, 100,000.
Yeah.
And then they basically just printed you out of your mortgage, right?
I think that's one of the biggest keys here is the leverage piece.
The leverage you have to use. Yes. So if you buy real estate as just a tail hedge, but no debt, the trade doesn't work because what you have to be is you have to be long, hard you have to be long, hard asset, and you have to be short the bonds, right? You got to be short the debt. And that's a hard trade to pull off normally, right? Like that is an exceptionally, like if you said like, if I was to express that in portfolios and say, hey, the next 10 years, we're going to be long gold and short US treasuries. This is a tough trade, right?
Yeah.
You got to have a lot of conviction in that, right? However, in real estate, it's like different. Particularly like, cause you can just live there and you got to live somewhere.
Yeah.
So this is why I'm a big advocate for like own your home for a lot of people.
Residence.
Yeah. Cause you can add that tail hedge by, owning your home. And there's some similar great benefits for families to own homes, right?
Yeah.
Great benefits. This family stability is probably amongst the top, but like it's just an interesting theory, a different framework to think about it. But what you don't need is to probably be like, hey, I want to put all of my money in a tail hedge, right?
Yeah.
Like if you have, if you get a little bit of money put together, you don't have a well-built portfolio net worth, and you just say, I want to go run and just say like, well, okay, well, if they're going to print a lot of money, then I'm going to go in this, this idea of like buy real estate because they will print me to success. Dude, the success you get on that is not going to be the success you really want. And if that's the only thing you have, like, okay, what happens if they don't?
Yeah.
What happens if everything turns out to be like generally okay?
What happens in that interim period time when you're waiting for that to happen and something happens with you or your family and you need that liquidity?
Or and when I talk about like being long gold and short bonds, like it's a complicated trade and it can be painful. Like you're in the same sort of idea owning a home, right? You're long a hard asset and you're short the mortgage, and like you still have to service that debt. So if in your own personal life, something comes up that just, you can't service that debt, lose your job, whatever, it becomes an issue. Right. And so
sometimes devastating.
I've seen people getting real financial snafus because all of a sudden, like, they're fine, their job's fine, their career's fine. And, they think they're cash flowing $100 or $200 a month or a couple $100 a month or whatever on the rental property. And then all of a sudden, somebody tears the place up, stiffs them with the last month's rent, and it takes, 4 or 5 months to get turned over. And so all of a sudden for 6-7 months, they got double mortgage payments and they got to come up with, $10,000-$15,000 to, turn over the property and, new carpet and paint and all the rest, right? Like puts people behind years, right?
Yeah.
Like, and you're making $200. So if you think about like, well, you're making $200 a month on net operating income, and, here comes an unforeseen, 6-month vacancy and $20,000 expense or something, all of a sudden it's easy to go like, well, there's 10 years worth of your return wiped out. And
plus the opportunity cost of what that money could have been doing.
Yeah. Yeah.
And I think that's another side of it that people don't like even think about most of the time.
Real estate is not sunshine and rainbows. Now, listen, if we have another housing crash, there will come a point where I will be like,
buy it all up.
Yeah. It's a valuations thing, right?
Yeah.
Real estate
just like with any investment though.
It still operates on fundamentals. And that's what I got to hit home, right? Is like real estate is so tough to disconnect from fundamentals, right? Like if you look at the stock market right now, stock market is also very overvalued. And I'm not generally an advocate right here of people buying, US stocks and holding with the plan of I'm going to hold them, right? Like
that buy and hold strategy.
Yeah. And the reality is because if you look at valuations, you run into the same kind of issue. Your forward-looking 10-year return is like zero, right? And the problem you run into though in that is that it's mark to market every day. It's traded a lot, and the stock market does disconnect from economic reality.
Whereas
quite commonly, right?
Does not do that.
Well, I think it would if it got marked to market and traded liquidly, but it doesn't.
But it doesn't,
And so like in in the stock market, you could have the stock market go up 20% a year for 3, 4, or 5, I don't know, 6 more years. You could have it go for 9 years. And then in year 10, it just all comes crashing down, right? Like, I don't know how it plays out, but I know in history, every time it gets this high, you wind up with a flat or negative 10-year forward-looking return, right? If you look at like a Shiller KP ratio, Shiller or KPE ratio, right? And the reality is real estate is in the same issue that like stock market is. That's my analysis of it, right? In general, right now that's painting with a very broad brush, right? Great time to buy great deals.
Yes.
But broadly speaking, you there's kind of this issue. Interest rates are too low, right? You're not getting compensated enough. If you're thinking inflation is going to go at 4%, you really want to get 4.25%. You know what I mean?
Nope.
0.25% real return over the next 10 years. Not good, right?
I think a lot of when I would say the general public is looking at real estate, they want to flock to that because they feel like it's something that they know. They feel like it's tangible and they can touch it and they have more control over it. But in reality, we need to understand the underlying fundamentals of the investment, just like any other type of investment.
Well, oftentimes what I hear is they say like, it's something real. I can go touch it. It feels like a real asset, right? Like it's a real thing, is what it's doing. Oftentimes we perceive that there's this sense of control, right? And the reality is like, you don't have control, right? You don't have any more control that your tenants are going to be good tenants than people are going to show up to Walmart tomorrow and buy stuff from your from your store, right? And newsflash, if you own a bunch of shares of Walmart, you own Walmart, right? Like a fractional, tiny little fractional part of all those buildings they own, all that inventory on the shelves, right? And when you go down to Walmart and you scan something and pay for it, and that generates some profit for them, you're getting some of that back into your own pocket as a shareholder. Yep. Right? Like that's the reality of it. And whether it's, and I just use, Walmart's just an example, right? Yeah. But insert any company, Apple, Coca-Cola,
Costco,
Home Depot, Costco, right? Like, but the reality is like all these businesses, you still got to look at it and say like, well, what am I owning, right?
Yeah.
And am I owning it or am I trading it? And the hard part with real estate is like, trading real estate is way more difficult because it's not liquid. And that's the reality of it, right?
Yep.
So it's a very, very goofy market, I'll just say, for any asset right now. Kind of sometimes people use the word like everything bubble, right? Hey, we're in an everything bubble. Not quite, but it's not far off from that.
Yeah.
I don't know that. I always teeter. I don't know that bubble is always the most appropriate word, but certainly a lot of valuations from a fundamental level are really quite high. So earnings need to come up to rise it. Productivity needs to increase, right? Inflation needs to decelerate. We're probably never going to have deflation, right? Deflation is not good. I don't
want to see that.
Actually, I'm going to retract that statement. My personal bias, my personal beliefs would be that deflation is actually a good thing. It would just be really, really hard.
But
believe me, not any of us, including myself, would want to live through deflation. No. But that's the reality, right? Is like, so you at least need inflation to decelerate, right? And that is to say, if it's going at 4% a year and you can get it to drop to as slow as 2% a year, that's kind of saying like you want to decelerate on the highway for going 80 miles an hour. You don't want to put it in reverse 60 and start going backwards, but hey, if you could drop it to 60 miles an hour, that's the deceleration, right? So you're not moving forward at such an accelerated pace. But there's a lot of forces that need to change to get that, I think, going in a meaningful way. But we'll see. I am optimistic about like AI potentially having productivity increases. Interesting second order effects or dynamics that spin off of that. But deregulation, especially for like home builders in general, is like a really interesting, favorable case, right? If it becomes easier to build homes all of a sudden, right?
Yeah.
I would say like labor or immigration was actually a really interesting, favorable case for real estate. The immigration policy under Biden, not that I care to dive into the political side of whether it was a good idea or not, but just more people, right? Especially if they're working for, lower wages, is good for housing, right? There's more people that build the houses and more people that need to live in them, right? So if you reverse that out, which the Trump administration appears to have done in a significant way, then that's not as favorable, right? So there's pros and cons across the whole space. But I think, look, it goes back to prudence. So if you have the opportunity to invest in real estate, you want to be able to run it through something like this, know the numbers, really dig in, make the projections and say, is this a good deal? And there is a way to determine if it's a good deal or not, right? And a lot of that is looking about inflation adjusting stuff, looking at opportunity costs, right? And then saying, hey, like, okay, it sounded good, but actually not. We actually run the numbers, it's maybe not.
Yeah.
And sometimes you run the numbers and you go, yep, great deal, jump on it, right?
Yeah.
I'd say that's way less common. I know myself, the last couple of years, we looked at a lot of deals personally when I was involved in the real estate business, with some former partners. We ended up doing 2.
Yeah.
And we looked at a lot of deals.
Yeah.
2. And one was not great. It ended up being, the return on it ended up compressing. Market and interest rates moved against us a little bit, which these are the things you deal with when you are trading real estate a little bit. And we would have wound up probably better having our money in cash yield at the time, right? Short-term treasuries. So the return was positive, but it was not spectacular, right?
Phenomenal. Yeah.
Way more work than it was worth. So net of return on hassle.
That's one of those other factors too that I think can get forgotten is, are you doing the work yourself? How many hours are you putting in? There's a lot that can go into that as well when you're factoring the numbers.
Yeah. Check this out. I always think when I'm making an investment now, and this was a lesson I really had to learn the hard way, as an investor personally, is you have to pass things through a metric that they do not teach you in finance, right? They never talked about this in my undergrad. They haven't talked about it in the master's program, none of it. And it's return on hassle, right? Yeah. Like, okay, I can get a little bit better return. Is it worth my hassle? Is it worth the hassle?
Worth the time, energy, effort that I have to put into it?
Is it worth me dealing with it in tax season? You know what I mean? Is it worth me taking all those extra forms, the extra phone calls? Is it worth the extra liability, right? Like,
yeah.
Is it worth me having to take time away from my day job or whatever else I'm doing to deal with this?
Yeah.
Right. And a lot of times if you just go, well, I can get something point and click with a mouse these days, that gives me the same return, then geez, I don't want the stuff that's more difficult just to say it's more difficult, right? What's the purpose you're really owning something for?
Yeah.
And I will cap that thought off with saying, if you are owning an asset because you want to be able to brag to people about it at a cocktail party or whatever, right? Like if you want to be the guy that shows up to a barbecue and you're like, I own rental properties or I own this fancy tech stock, dude, Godspeed. That almost is a great signal that that's the market you want to get away from, right? So if you have friends bragging about something at a cocktail party, that's generally like the asset, you want to just start getting cautious.
Opinion.
Yeah, start getting cautious on that asset. Yeah. And what I know is the last couple of years, it has been, just a lot of social media attention
around real estate.
It's been the conversation at networking events and social settings or whatever. Like, oh yeah, take that for what it's worth. But go do the things that people aren't talking about.
Yeah.
And that's usually where you make the better forward looking return, right? Because what everyone's already bragging to you about is that they've made the return. Mm-hmm. That means there's probably not as much to go going forward.
Yeah.
So you got to go do the things that they're not talking about.
Yeah.
Right.
So I guess to kind of just do a quick recap here at the end of this episode is just really understand the numbers. Make sure you're looking at it without the biases, like the recency bias.
Yeah.
Just consider it like an investment, like any other type of investment, and go through the numbers, recognize, is this a good deal? Is this not? And be okay with that.
If you stick with the numbers, you'll probably sleep better at night and probably have a higher likelihood of success in the future. Yeah. That's the reality of it.
Yeah.
So, not fun in the present always.
No.
But
it can be disappointing. Like thinking you've got a great opportunity and then you run the numbers and you're like,
but
I was excited about that.
The Tall Oaks brand is about being real people, but it's also about making good, prudent, long-term decisions, because that's what grows. Oak trees grow inch by inch. They don't grow foot by foot.
Yeah.
So,
hopefully this is helpful to any of you that are interested in real estate and purchasing, to give you a better understanding of like these considerations, things to look at, what's happening with the economics and the behind the scenes of interest rates and things like that, because that all plays a part.
Well, and like, I know a number of people that listen to this podcast are financial advisors. But B, there's people that listen to this that are do-it-yourself investors, right? Mm-hmm. And then there's people that hire professionals. And the reality is like, if you're hiring somebody to help you with wealth management or financial planning, they should be able to have this conversation with you, right?
Yeah, absolutely.
So you want to have this kind of conversation with your financial advisor, not your real estate agent. That's, what I mean? You want to have
there's a bias there.
You want to talk to the real estate agent maybe to understand what your inputs might be, but then you want to sharpen it up and say, okay, is this a good deal for me? That's your financial advisor, right? Yeah. That they're supposed to advise you on that. And if like my quick add on here is like, if you're hiring somebody that you perceive to be your finance guy or your money guy or your financial advisor, your financial planner, whatever, insert X term they just choose to call themselves here, right? If they say if like they only do like stocks and bonds, or you know what I mean, like they only do mutual funds, or it's like every time you talk to them they only want to talk to you about life insurance, then the reality is like you don't have a financial advisor. You've got you've got a stocks and bond salesman.
You got somebody that's just pushing a product.
Yep. Remember the 5 key competencies of wealth management, right? Income planning, tax planning, estate planning, insurance planning. All of those things will touch real estate, and then your investment planning.
Yeah.
Right. Or management, and the real estate is an investment.
Yeah.
And it interacts with all 4 of the other categories really heavily. So if you want actual financial advice, you got to be talking with a good professional about all of 5 of those things in this conversation. Right.
Yeah.
So whoever you're working with, tell them point blank, you got to help me analyze this deal. And if you don't want to help me analyze this deal, help me understand why I'm paying you or hiring you or why I work with you. So
I think that's very fair.
Let's wrap it on that. Always appreciate you spending the time to do these analysis. Appreciate everyone tuning in and following along with us. Hit us with your questions. We've got some questions about real estate investing in general that we've collected up recently. Kind of as we were preparing for this episode and telling some people about it, we were going to do this. So we'd love to add some more to that. Yeah. So if you've got an interest in real estate, or whether it's investment properties, or just how do I use this my own real estate, or how do I buy a home, or is mortgages a good idea? Whatever it is, right? Like, send us a message, email us, leave a comment, whatever it is, and we will try to add that question in and address your questions, concerns, comments, jokes, and I will even address hate mail if you want in the next episode when we film that. So
look forward to it.
Okay. See you guys out there.